Legal disclaimer. The following content is strictly for educational, informational, and entertainment purposes only. It does not constitute financial, investment, legal, or tax advice. Foreign exchange Forex. Trading involves a significant risk of loss and is not suitable for all investors. The high degree of leverage associated with Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance is not indicative of future results. Any mention of specific currencies, pairs, or market scenarios is for illustrative case study purposes only, and should not be construed as a recommendation to buy or sell. By continuing to watch or read this content, you acknowledge that you are solely responsible for your own financial decisions and due diligence. Narration. Stop trading. Put your phone down, close your terminal, and step away from the buy button. Seriously, if you do not understand the fundamental mechanics of what happens when you execute a trade, you are not an investor. You are liquidity. You are the food that the institutional sharks eat every single morning. Let's look at the cold, hard reality of the market you are trying to enter. The foreign exchange market is the largest, most liquid financial market in the history of human civilization. Every single day, roughly $7.5 trillion changes hands. To put that into perspective, that is significantly larger than the entire annual GDP of Japan, traded back and forth every 24 hours. It dwarfs the New York Stock Exchange so massively that if the NYSE were a single grain of sand, the Forex market would be the entire beach. Yet, despite this ocean of money, the statistics for retail traders, people like you sitting at home with a laptop and a dream, are devastating. Data from major regulatory bodies and brokerage reports consistently suggest that between 70 and 90% of retail Forex traders lose money. Most blow up their entire account within 90 days. Why? Is the market rigged? Is it impossible to win? No. The reason most new traders fail is not because they can't read a chart, or because they don't know what a candlestick pattern looks like. They fail because they fundamentally misunderstand the asset class itself. They treat Forex pairs like stocks, and that is a fatal error. When you buy a stock, you are buying a piece of a company. You are betting on its absolute success. When you trade Forex, you are entering a gladiator arena where two national economies are fighting to the death, and you have to bet on the winner in real time. You are not buying an asset. You are speculating on a relationship. If you do not understand the microscopic details of how a currency pair functions, the push and pull, the mathematical ratio, and the economic warfare that dictates the price, you are gambling on a coin toss while the professionals are playing three-dimensional chess. This is the Understanding Forex Pairs Masterclass. This is not a 5-minute summary. This is a deep dive reconstruction of your trading education. Over the course of this series, we are going to tear down the misconceptions you have learned from 30-second social media clips and rebuild your knowledge base from the ground up. We are going to transform you from a gambler guessing red or black into a strategist who understands the ebb and flow of global capital. By the end of this journey, you will never look at a ticker symbol the same way again. You will see the narrative, the conflict, and the opportunity hidden inside the quote. Let's begin by addressing the single biggest psychological trap that catches new traders before they even place their first lot. It is the single asset fallacy. In almost every other area of our lives, value is perceived as absolute. If you go to the store to buy a gallon of milk, the price is the price. If you buy real estate, you look at the house. If you buy shares of Tesla, you are analyzing Tesla. You look at their car sales, their CEO, their battery technology. If Tesla does well, the stock generally goes up. It is a linear relationship. Forex does not work that way. There is no such thing as simply buying the dollar or selling the yen. It is physically impossible to trade a currency in isolation. You must trade it against something else. This is why we have pairs. The very existence of the Forex market is built on the concept of relativity, not absolute value. Imagine a game of tug-of-war. On the left side of the rope, you have the United States economy. You have the Federal Reserve, interest rates, employment data, and geopolitical power. On the right side of the rope, you have the Eurozone. You have the European Central Bank, inflation data from Germany, and manufacturing output from France. The price you see on your screen for the euro to US dollar pair is simply a marker on that rope. It shows you who is pulling harder at this exact second. Here is where it gets complicated and where the single asset fallacy destroys accounts. Let's say the United States releases incredible economic data. Unemployment is down, GDP is up, and the economy is booming. A novice trader looks at this and thinks, the US dollar is strong. I should buy the dollar. So they open a trade expecting the dollar to rise. But the trade collapses. They lose money. They stare at the screen in confusion, screaming that the market makes no sense. The news was good. Why did the dollar drop? The answer lies in the pair. Yes, the US news was good. But what if the European news was better? What if the US economy is pulling on the rope with a force of 1,000 pounds, but the European economy is pulling with a force of 2,000 pounds? Even though the US is strong, it is relatively weaker than Europe. In the world of Forex pairs, being good isn't enough. You have to be better than the opponent you are paired against. This concept of relative strength is the heartbeat of the Forex market. You are always simultaneously buying one currency and selling another. You cannot be long the dollar without being short something else. This means you have to analyze two economies simultaneously. You have to be an expert on both sides of the trade. If you only look at one side of the coin, you are trading blind. Furthermore, we have to discuss the mechanism of the exchange rate itself. When you see a quote for pound sterling to US dollar, the British pound against the US dollar, and the price is 1.2500, what does that actually mean? It is not just a random number generated by a computer. It is a precise mathematical ratio. It is the market telling you that at this specific moment in time, one single British pound is worth $1.25 of American currency. This seems simple, but the implications are profound. It means that for the chart to move up, one of two things must happen. Either the pound must get stronger, or the dollar must get weaker. Or, in a volatile market, the pound could get strong while the dollar gets weak simultaneously. That is when you see those massive vertical green candles that make traders rich or bankrupt in seconds. Conversely, for the chart to go down, the pound must weaken, or the dollar must strengthen. The chart is a visual representation of this constant, violent battle for dominance. Why does this matter to you right now? Because most new traders treat the currency pair as a static object. They think of it like a betting slip. They do not realize that the pair is a living, breathing reflection of global sentiment. When you trade a pair, you are participating in the global barter system. You are exchanging value. Let's take a step back into history to understand why we even trade in pairs. Before 1971, the world operated largely under the Bretton Woods system, where currencies were pegged to the US dollar, which was in turn pegged to gold. Exchange rates were fixed. There wasn't much trading to be done because the prices didn't move. But when President Nixon ended the gold standard, currencies were allowed to float. Suddenly, the value of the French franc or the German mark wasn't fixed. It was determined by supply and demand. If Toyota in Japan wanted to buy steel from the US, they had to sell yen and buy dollars. If a US hedge fund wanted to invest in London, they had to sell dollars and buy pounds. This created the modern Forex market. It is a market born out of necessity for international trade, but it has evolved into a speculative beast. Today, the vast majority of that $7.5 trillion daily volume we talked about is not Toyota buying steel. It is speculation. It is banks, hedge funds, and algorithms betting on the future value of these pairs. When you open your brokerage account, you are stepping into this flow. You are looking at the major pairs, the minor pairs, and the exotics. These aren't just categories. They represent different levels of risk, liquidity, and volatility. A major pair like the euro to US dollar is like a highway. It is liquid, it moves smoothly, usually, and the costs to trade it are low because there is so much volume. An exotic pair, like the US dollar against the Turkish lira, is like off-roading in the jungle. The moves are massive, the costs are high, and the danger is extreme. In this deep dive masterclass, we are going to dissect these categories. We are going to teach you how to read the quote currency and the base currency, so you never get confused about which direction you are actually trading. We are going to explain pips, the percentage in point, and why a movement of the fourth decimal place can mean the difference between a steak dinner and a margin call. But before we get to the math, you must internalize the philosophy. A Forex pair is a relationship. Relationships are complicated. They are influenced by external stress, internal conflict, and third-party interference. If you are looking for a get-rich-quick scheme, or a magic indicator that tells you when to buy, turn this video off. It does not exist. But if you are ready to learn the language of the global economy, If you are ready to understand why the price moves, and if you are willing to respect the risk of the arena you are entering, then you are in the right place. We are about to unlock the code of the currency pair. We are going to explore the base, the quote, the bid, the ask, and the spread. We are going to show you why the chart looks the way it does and how to spot the imbalance between two nations before the rest of the market reacts. This is your education. This is part 1. Welcome to the world of Forex. Now look at your trading terminal. You are staring at a string of 6 letters. It looks like a code, and that is exactly what it is. To the uninitiated, seeing Eurist or GBP/JPY is just alphabet soup. But to a professional trader, this is a precise coordinate system. Before you can predict where the price is going, you have to understand the strict architectural hierarchy of these 6 letters. We need to dissect the anatomy of the pair. This is not random. The system we use today is based on ISO 4217, a standard published by the International Organization for Standardization. This standard ensures that whether you are a hedge fund manager in New York, a central banker in Tokyo, or a retail trader in London, you are speaking the exact same language. The first 2 letters of any currency code usually identify the name of the country, and the third letter identifies the name of the currency. Take USD. US stands for the United States, and D stands for dollar. Take JPY. JP stands for Japan, and Y stands for yen. This seems elementary, but it is the foundation of the global ledger. When these codes are smashed together to form a pair, they create a specific structure that dictates the math of your profit and loss. The first currency listed in the pair, the one on the left, is known as the base currency. The second currency, the one on the right, is known as the quote currency, sometimes called the counter currency. Memorize this rule because it is the immutable law of the Forex market. The base currency is always equal to 1. The base currency is the reference point. It is the anchor. When you look at a chart of euro to US dollar and you see a price of 1.0950, the market is answering a very specific question. How many US dollars, the quote, does it take to purchase exactly 1 euro, the base? In this example, the answer is $1.09.5. The base is the good being bought or sold. The quote is the money being used to pay for it. Let's deepen this with a buy scenario. Imagine you analyze the European economy. You see that the European Central Bank is raising interest rates, which generally attracts investment and strengthens a currency. You decide to buy euro to US dollar. In this transaction, because the euro is the base currency, you are buying euros. But remember the tug of war from part 1? You cannot just buy euros in a vacuum. To pay for those euros, you are simultaneously selling US dollars. You are exchanging the quote currency to acquire the base currency. If the price on the chart goes up, it means the euro is becoming more valuable relative to the dollar. It now takes more dollars to buy that same single euro. If the price moves from 1.0950 to 1.1050, the euro has strengthened. If you bought at the bottom, you can now sell that single euro back to the market and get more dollars than you originally paid. That difference is your profit. Now consider the short side. This is where 80% of new traders get confused. How can you sell something you do not own? In the stock market, short selling is a complex process involving borrowing shares. In Forex, because everything is a pair, shorting is seamless and instant. When you click sell on euro to US dollar, you are doing the exact opposite of the previous example. You are selling the base currency, the euro, and you are buying the quote currency, the dollar. You are betting that the value of the euro will drop relative to the dollar. Imagine you click sell at 1.0950. You are essentially saying, I believe that in the future it will take fewer dollars to buy this euro. If the price crashes down to 1.0850, you were right. The euro became cheaper. You can now close your position, which effectively buys back the euro at the lower price, pocketing the difference. This bidirectional nature is why Forex is so attractive compared to traditional buy and hold stock investing. You can potentially profit just as easily from a crashing economy as you can from a booming one, provided you understand which side of the pair represents which economy. But why is it euro to US dollar? Why don't we ever see US dollar to euro? This brings us to the concept of currency hierarchy. The Forex market has an established pecking order that determines which currency is listed as the base and which is listed as the quote. This hierarchy generally follows a historical precedence of dominance and value. At the top of the food chain is the euro. If the euro is involved in a pair, it is almost always the base currency. Next is the British pound GBP, followed by the Australian dollar, AUD, and the New Zealand dollar, NZD. Then comes the US dollar, USD. This is why you see euro to US dollar, euro is dominant. Pound sterling to US dollar, pound is dominant. But you see US dollar to Canadian dollar, US dollar is dominant over the Canadian dollar, and US dollar to Japanese yen, US dollar is dominant over the yen. This hierarchy matters because it dictates how you read the chart. If you are trading US dollar to Canadian dollar, and the chart is flying upwards like a rocket, it means the US dollar is getting stronger, or the Canadian dollar is getting weaker. However, if you are trading euro to US dollar, and the US dollar is getting stronger, the chart will crash downwards. Why? Because in euro to US dollar, the dollar is the quote currency. If the quote gets stronger, it takes fewer of them to buy the base. Therefore, the exchange rate number gets smaller. This inverse correlation is a critical concept to master. A strong US dollar pushes US dollar to Canadian dollar up, but it pushes euro to US dollar down. A novice trader who doesn't understand this might see positive news for the US economy and blindly click buy on everything, not realizing they just bet against themselves on half their trades. Let's solidify this with a practical high-stakes case study. Imagine a scenario involving the cable, the nickname for the pound sterling to US dollar pair, dating back to when exchange rates were transmitted via a literal cable under the Atlantic Ocean. It is 2016. The Brexit vote is coming in. The polls are closing. You are sitting at your desk. The pair is pound sterling to US dollar. The pound is the base. The dollar is the quote. If you believe the UK will vote to remain in the EU, you expect stability and a strong pound. You would go long by GBP, sell USD. You want the chart to go up. But the results start coming in. The Leave vote is winning. Panic sweeps the London markets. Investors dump the pound. They want out of the sterling and into the safety of the US dollar. Massive selling pressure hits the base currency, GBP. Simultaneously, massive buying pressure hits the quote currency, USD. As a safe haven, what happens to the pair? It collapses. It doesn't just drift down, it falls off a cliff. In this real historical event, the pound sterling to US dollar dropped over 1,700 points in a single night. If you had understood the anatomy of the pair, you would have known that a weak pound and a strong dollar creates a short scenario. Traders who recognized this fundamental shift and shorted the pair made fortunes overnight. Traders who didn't understand why the chart was moving, or who thought the drop has to stop eventually, were wiped out. This leads us to the most dangerous misconception in trading pairs: the idea that price is just a number. In the stock market, if a stock is $100, that's the price. In Forex, the price is usually a number like 1.2345. Why so many decimal places? Why do we need to know the price of a currency down to the 10,000th of a unit? This is where the pip comes in. The price interest point. You might look at a move from 1.1200 to 1.1201 and think, that is nothing. That is a fraction of a penny. Who cares? You should care. In fact, you should be terrified of that tiny move. Because in the world of Forex, we don't trade one unit of currency. We trade lots. We trade standardized blocks of 100,000 units of currency at a time using leverage. That tiny invisible movement of 0.0001, when multiplied by the leverage used by institutional and retail traders, that fraction of a penny can represent hundreds, thousands, or even millions of dollars in profit or loss. You have learned the structure. You know the base is the boss and the quote is the money. You know the hierarchy. But knowing the structure is useless if you don't know how to measure the movement. How do you calculate if a trade is worth the risk? How do you know if a chart movement will double your account or liquidate it? The secret lies in the fourth decimal place. In the next part of this masterclass, we are going to break down the mathematics of the pip, the lot, and the leverage. We are going to explain why a micro lot might save your career, and why a standard lot is a weapon that should only be handled by experts. We are going to show you exactly how to calculate your risk down to the penny before you ever press that button. The math is boring to some, but in Forex, the math is the only thing standing between you and financial ruin. Let's look at that fourth decimal place. In the euro to US dollar pair, if the price is 1.1000, that last zero is the pip. If the price moves to 1.1001, the market has moved 1 pip. If it moves to 1.1010, it has moved 10 pips. Pip stands for percentage in point, or price interest point. It is the atomic unit of the Forex universe. In the stock market, you measure movement in dollars and cents. If Apple stock goes from $150 to $155, you made $5 per share. Simple. In Forex, because the exchange rate moves in such tiny increments, we cannot talk in dollars. We talk in pips. Now, there is one major exception to the fourth decimal rule that you must memorize immediately to avoid a catastrophic calculation error. This exception applies to the Japanese yen. Whenever the Japanese yen is the quote currency, the currency on the right side, like US dollar to Japanese yen or pound sterling to Japanese yen, the pip is the second decimal place, not the fourth. If US dollar to Japanese yen is 130.50, and it moves to 130.51, that is 1 pip. This difference exists because the yen has a much lower unit value than the dollar or euro. If you try to calculate your risk on a yen pair using the fourth decimal place logic, you will miscalculate your position size by a factor of 100. That is the difference between risking $50 and risking $5,000 by accident. But knowing what a pip is doesn't tell you how much money you are making. A pip is just a measure of distance. To turn distance into dollars, we need to introduce the concept of volume, or in Forex terminology, the lot. This is where the scale of the Forex market becomes apparent. You cannot go to the interbank market and buy €1. The banks do not deal in pocket change. They deal in standard lots. A standard lot represents 100,000 units of the base currency. Let's run the math on this. If you are trading a standard lot of euro to US dollar, you are effectively controlling 100,000 euros. If the price moves 1 pip, 0.0001, what is the value of that movement? You take the transaction size, 100,000, and multiply it by the pip size, 0.0001. The result is 10. This means that for every single pip the market moves, your account fluctuates by $10. Now, $10 might not sound like much, but remember the volatility we discussed in part 2? The pound sterling to US dollar dropped 1,700 pips during Brexit. If you held just one standard lot during a 1,700 pip move, that is a profit or loss of $17,000. However, most retail traders do not start with enough capital to safely trade standard lots. This is why brokers created smaller unit sizes. Below the standard lot, we have the mini lot. This is 10,000 units of currency. It is 1/10 the size of a standard lot. Consequently, the value per pip is $1. Below that, we have the micro lot. This is 1,000 units of currency. The value per pip is 10 cents. 10 cents. This is the most critical structural decision you will make, choosing your lot size. Imagine a scenario where you have a $500 trading account. You are feeling confident. You heard someone online made a killing, so you decide to open a standard lot. You hit buy. Immediately, you are trading at $10 per pip. The market breathes. It moves 20 pips against you. A tiny, insignificant ripple in the grand scheme of the daily chart. But for you, that is 20 pips times $10. That is a $200 loss. In a matter of minutes, you have lost 40% of your entire account balance on a routine market fluctuation. If the market moves 50 pips against you, your account is gone. You have been margin called. The broker closes your trade automatically to protect themselves, and you are left with zero. This leads us directly to the mechanism that allows a person with $500 to control $100,000 of currency in the first place. Leverage. Leverage is the superpower of the Forex market, but it is also the primary reason new traders go broke. Leverage is essentially a loan provided by your broker. It allows you to control a large position with a small amount of capital. When you see a broker offering 1:100 leverage, it means that for every $1 of your own money you put up as collateral, known as margin, the broker allows you to control $100 of currency. Let's break down the mechanics of a trade using 1:100 leverage. You want to buy that standard lot of euro to US dollar, 100,000 units. Without leverage, you would need to have roughly $110,000 in cash sitting in your account to make that trade. Obviously, most people don't have that. With 1:100 leverage, you only need 1% of the total value. You put up roughly $1,100 of your own money as a good faith deposit, or margin. The broker essentially fronts the rest of the buying power. This sounds fantastic, right? You can make massive profits with a small account. If you have $1,000 and you use leverage to make a 10% return on the position size, you could double your account in a day. But here is the trap. Leverage magnifies losses exactly the same way it magnifies gains. The market does not know how much money you have in your account. It only knows how big your position is. If you control a $100,000 position, your wins are based on $100,000, and your losses are based on $100,000. If that position drops by just 1% in value, the loss is $1,000. If your account only has $1,000 in it, that 1% drop wipes you out completely. You lose 100% of your equity on a 1% market move. This is the over-leveraging phenomenon. Case studies of successful traders suggest they rarely use the maximum leverage available. Just because your broker offers you 1:500 leverage, allowing you to control $500 for every $1, does not mean you should use it. That is like driving a car that can go 200 miles per hour. Just because the engine can do it, doesn't mean you should drive 200 miles per hour through a school zone. You will crash. To survive, you must understand the relationship between your account balance, your lot size, and your leverage. Let's do a sanity check calculation that you should perform before every trade. Step 1. Identify your stop loss. We will cover the technicals of where to place this later. But let's say you are willing to let the price move 20 pips against you before you give up. Step 2. Calculate the cost. If you are trading a mini lot, $1 per pip, a 20 pip loss equals $20. Step 3. Compare to your account. If you have a $1,000 account, $20 is 2% of your balance. This is generally considered a safe, professional risk parameter. However, if you were trading a standard lot, $10 per pip, that same 20 pip loss would be $200, or 20% of your account. Losing 20% on a single trade is catastrophic. Mathematically, it is incredibly difficult to recover from a 20% drawdown. You would need to make a 25% profit on your remaining capital just to get back to break-even. This is why the boring math is your survival kit. The market is designed to take money from the impatient and transfer it to the calculated. The impatient trader looks at leverage and sees buying power. The calculated trader looks at leverage and sees risk exposure. So we have covered the pair, the pip, the lot, and leverage. You are almost ready to execute. You know what you are buying, how to measure it, and how much to buy. But wait, look closely at your trading terminal again. You will notice something strange. There isn't just one price for euro to US dollar. There are two. There is a bid price and an ask price, and they are never the same. The moment you click buy, you are instantly in a loss. You haven't even waited for the market to move, and your profit/loss column shows negative red numbers. Why? Is the broker cheating you? Is the system lagging? No. You just paid the toll to enter the highway. This is called the spread. And if you don't understand how the spread widens in contracts during news events or market closes, it can liquidate your position, even if the price on the chart never actually hits your stop loss. We are about to expose the hidden costs of trading. We are going to look at the bid-ask spread, commissions, and the mysterious swap fees that charge you just for holding a trade while you sleep. Understanding these costs is the difference between a strategy that wins on paper and a strategy that actually makes money in the real world. Let's uncover the business of the broker in part 4. You are looking at the bid and the ask. This is the most fundamental friction in the market, and yet, it is the concept that bleeds the accounts of scalpers and day traders dry without them even realizing it. Let's strip away the digital interface and go back to a physical example you have likely experienced. Imagine you are at an international airport. You walk up to the currency exchange kiosk. You have $100 in your hand, and you want to buy euros. The sign on the wall says the exchange rate is 1.10. Mathematically, you should get roughly 90 euros. But you don't. The clerk hands you 85 euros. You are confused. You point at the screen. The clerk points to a smaller number, the we sell price. Then 5 minutes later, you realize you made a mistake and need your dollars back. You hand those same 85 euros back to the clerk. Do they give you your original $100 back? Absolutely not. They give you $92. In the span of 5 minutes, without the actual market rate moving a single inch, you lost 8% of your money. Where did it go? It went into the pocket of the exchange bureau. That gap between the price they buy at and the price they sell at is the spread. In the Forex market, your broker is that kiosk. When you click buy, you are paying the ask price, the higher price. When you click sell, you are receiving the bid price, the lower price. This creates an immediate mathematical handicap. If the spread on euro to US dollar is 2 pips, and you enter a trade, the market must move 2 pips in your favor just for you to break even. You are starting the race 10 meters behind the starting line. For a long-term investor looking for a 500 pip move, a 2 pip spread is negligible. It is a rounding error. But for a scalper, a trader trying to snatch 5 or 10 pips of profit from the market repeatedly, a 2-pip spread is a 20% to 40% tax on every single transaction. If you are aiming for 10 pips but paying 2 pips to enter, you effectively need the market to give you 12 pips of value to keep 10. Over 1,000 trades, this friction destroys statistical edges. But here is the trap that catches the sophisticated traders: the variable spread. Most brokers offer variable spreads. This means the gap between the bid and the ask is not fixed. It breathes. It reacts to liquidity. Imagine it is 8:29 a.m. in New York. The non-farm payrolls (NFP) report, the most important economic data in the United States, is released at 8:30 a.m. The market is tense. Liquidity providers, the big banks, pull their orders because they are afraid of the volatility. Suddenly, the spread on your terminal explodes. It goes from 1 pip to 20 pips in a split second. Now imagine you had a long position open with a stop loss sitting 15 pips below the current price. The chart price, the midpoint, hasn't moved yet. But because the spread widened by 20 pips, the bid price, the price that triggers your sell stop, drops low enough to hit your stop loss. You are taken out of the trade. You lose money. Then, 2 seconds later, the news comes out, the spread tightens back to normal, and the price skyrockets in the direction you predicted. You were right about the direction, but you lost money anyway. New traders call this market manipulation, or stop hunting. While manipulation does exist 90% of the time, this is simply the mechanics of liquidity and spread widening. You failed to account for the cost of doing business during a high-impact event. Beyond the spread, we have commissions. Some brokers offer zero-spread accounts. They claim you can trade with raw market prices directly from the interbank providers. This sounds amazing. You see the bid and ask almost touching. But nothing in life is free. In exchange for zero spreads, the broker charges a fixed commission per lot. Usually, this is around $3.50 per lot per side. That means to open and close a trade, you pay $7. You have to do the math. Is it cheaper to pay the spread markup? Or is it cheaper to pay the flat commission? Generally, for high-volume, short-term traders, the commission model, often called an ECN or raw account, is mathematically superior because it offers transparency. For swing traders who trade less frequently, the standard account with a spread markup might be simpler. Now let's discuss the cost that hits you while you sleep: the swap or rollover. The Forex market is a 24-hour market, but the banks still have a close time. At 5 p.m. New York time EST, the trading day officially ends and the next one begins. If you are holding a position open past this cutoff time, your position must be rolled over to the next day. This is not just a clerical procedure. It involves actual interest rates. Remember, when you trade a pair, you are borrowing one currency to buy another. Let's look at a theoretical scenario. Imagine the interest rate in the United States is 5%, and the interest rate in Japan is 0%. If you buy US dollar to Japanese yen, you are buying the dollar earning 5% interest, and borrowing the yen paying 0% interest. The difference is plus 5%. The broker will actually pay you to hold this trade. This is called a positive swap. Large hedge funds build entire strategies around this, called carry trades, where they simply hold high-interest currencies against low-interest ones to collect the yield. However, consider the reverse. If you sell US dollar to Japanese yen short, you are selling the dollar, paying 5% interest to borrow it, and buying the yen earning 0%. You are now in a net negative interest position. Every single night at 5 p.m., the broker will deduct money from your account to cover this interest. If you hold a negative swap trade for weeks or months, that daily fee eats away at your potential profits like termites. I have seen traders be right about a long-term trend, but because they were on the wrong side of the interest rate differential, the swap fees ate 50% of their total profit. You must check the swap rates on your broker's contract specifications before you plan a long-term hold. Finally, we must address the elephant in the room: the business model of your broker. Understanding who is on the other side of your trade is a matter of survival. There are generally two types of brokers: A-book and B-book. An A-book broker, often STP or ECN, acts as a bridge. You place an order, they pass it directly to a liquidity provider like a major bank, and they charge you a commission for the connection. They do not care if you win or lose, they just want you to keep trading so they can collect commissions. Their incentive aligns with yours. They want you to survive. A B-book broker, often called a market maker, is the market. When you buy, they sell to you. When you sell, they buy from you. They keep your trade in-house. This creates a direct conflict of interest. If you win $1,000, the broker loses $1,000. If you lose $1,000, the broker keeps it. Now, this is not inherently illegal or a scam. Provides liquidity. But statistically, since most retail traders lose money, B-book brokers can afford to take the other side of your trades because the odds are you will lose on your own. However, if you are a consistently profitable trader, a B-book broker might not like you. They might requote you, delay your execution, or eventually ask you to leave. Case studies suggest that for serious trading, you want an environment with minimal conflict of interest. You want to ensure that your broker profits when you trade volume, not when you lose your equity. We have now built the vehicle. You understand the pair, the engine, the pip, the speedometer, the leverage, the fuel, and the costs, the toll roads. But a vehicle is useless if you don't know the traffic laws. You can have the best strategy in the world, but if you try to drive it during a hurricane, you will crash. The Forex market is not always open for business. Well, technically it is, but there are specific times when the money flows and specific times when the market is dead. There are times when you should be aggressive and times when you should be asleep. We are about to enter the world of market sessions. We are going to break down the three great centers of capital: Tokyo, London, and New York. We will explain why the London Open is the most dangerous and profitable time of the day, and why the New York overlap is where the real volatility lives. If you are trading euro to US dollar at 5 p.m. Eastern Standard Time, you are wasting your time. Let me explain why in Part 5. The Forex market is marketed as a 24-hour market. Brokers love to plaster this on their landing pages. They tell you that you can trade whenever you want, before breakfast, during your lunch break, or in the middle of the night. Technically, they are not lying. The market is open 24 hours a day, 5 days a week. But practically, this is one of the most misleading truths in the industry. Trading euro to US dollar at 5 p.m. Eastern Standard Time is akin to trying to surf in a swimming pool. The water is there, but the waves are gone. At 5 p.m. New York time, the US banks are closing, the European bankers are asleep, and the Asian markets haven't fully ramped up. This is the rollover period we mentioned. Liquidity dries up instantly. When liquidity disappears, spreads widen artificially. You might see a spread jump from 1 pip to 10 pips simply because there is no one on the other side of the wire to take the order. If you try to trade during this dead zone, you are fighting friction, not price action. To trade successfully, you must treat the Forex market not as a continuous stream, but as a series of 3 distinct relay races. Each race has a different personality, a different speed, and a different set of rules. These are the major sessions: the Asian session, the London session, and the New York session. It starts with the Asian session, often anchored by Tokyo. This kicks off roughly around 7 p.m. Eastern Standard Time, depending on daylight savings. The Asian session is known for being the calm before the storm. Historically, volatility is lower here. The big institutional money in Europe and America is offline. The primary participants are central banks in Japan, exporters in China, and commercial centers in Singapore and Australia. If you are an aggressive trader looking for 100 pip moves in 20 minutes, the Asian session will frustrate you. It is characterized by range-bound price action. Prices often drift sideways, respecting clear support and resistance levels. Case studies suggest that strategies based on mean reversion, betting that the price will return to the average, perform better here. However, you must be selective about your pairs. Trading a European pair like euro to pound sterling during the Asian session is like watching paint dry. There is no domestic news to drive it. Instead, you should focus on the pairs that live in this time zone: US dollar to Japanese yen, Australian dollar to US dollar, and NZD/USD. These pairs have a pulse because their economies are awake. Then the world shifts. The sun rises over Europe. At 3 a.m. Eastern Standard Time approximate, the London session opens. This is the heavyweight champion of the world. London is the global hub of foreign exchange, responsible for roughly 43% of all daily transaction volume. When London opens, the market explodes. The Asian range that was established over the last 8 hours is often shattered. This is where you see the London breakout. Trends that will last for the entire day often begin right here. But there is a danger lurking at the London Open. It is a phenomenon known among professional traders as the Judas swing, or the false breakout. Often, right at the open, institutional algorithms will push the price aggressively in one direction to trigger the stop losses of retail traders, only to violently reverse and go the other way for the rest of the day. Imagine you see the price break out to the upside at 3:05 a.m. You buy, thinking the trend has started. By 3:30 a.m. the price has collapsed, your stop is hit, and the real trend is moving down. You provided the liquidity for the smart money to enter their short positions. This session is volatile. It is fast. It respects momentum. The major pairs, Euro to US dollar, Pound sterling to US dollar to Swiss franc, are the stars of this show. Finally, we have the New York session. This opens at 8 a.m. Eastern Standard Time. The US dollar is involved in nearly 90% of all Forex trades. When New York wakes up, the volume is immense. But the magic doesn't come just from New York opening. It comes from the convergence of the two giants. Between 8 a.m. Eastern Standard Time and 12 p.m. Eastern Standard Time, the London session and the New York session overlap. This 4-hour window is the golden time, or the kill zone. During this overlap, the biggest banks in Europe and the biggest banks in America are effectively shouting at each other across the Atlantic. Hedge funds are rebalancing portfolios. Corporations are hedging exposure. The volume is at its absolute peak. For a retail trader, high volume is your best friend. High volume means tighter spreads, lowering your costs, and cleaner moves. If a chart is going to make a decisive move that respects technical analysis, it is statistically most likely to happen during the overlap. This is also when the most critical economic data is released. The U.S. non-farm payrolls, the Consumer Price Index, CPI, and interest rate decisions usually drop at 8:30 a.m. or 10 a.m. Eastern Standard Time. Let's look at a hypothetical scenario to illustrate the importance of timing. Trader A lives in California. He gets home from work at 6 p.m. Pacific Standard Time, 9 p.m. Eastern Standard Time, and decides to trade pound sterling to US dollar. He looks at the chart. It looks choppy. He enters a trade. The market moves 2 pips up, 3 pips down. He holds the trade for 4 hours. He is exhausted. He closes for a tiny loss or break even. He thinks the market is rigged. Trader B lives in London. She wakes up and sits at her desk at 8 a.m. Greenwich Mean Time, 3 a.m. Eastern Standard Time. She watches pound sterling to US dollar. She sees the volume spike. She spots a breakout pattern. She enters. Within 45 minutes, the pair moves 50 pips. She takes her profit and goes to breakfast. Same pair. Same day. Completely different outcome. The difference wasn't the strategy, it was the session. You must adapt your lifestyle to the market, not the other way around. If you live in a time zone that doesn't align with the London or New York sessions, you have to make a choice. Become a swing trader, holding trades for days, so intraday timing matters less, or wake up early/stay up late to catch the overlap. Furthermore, you must be aware of the London close. Around 11 a.m. to 12 p.m. Eastern Standard Time, European traders go home. They close their positions. This often causes a reversal or a retracement. If the trend has been up all morning, you might see a sudden drop at 11:30 a.m. This isn't a change in the trend. It is simply Europe taking profit before they head to the pub. If you enter a trend trade right at the London close, you are often buying the exact top of the day. So we have the vehicle, the pair, the mechanics, the lot/pip, the cost, the spread, and the roadmap, the sessions. You know when to look at the chart. But when you look at it, what actually moves the price? Why does the US dollar suddenly rocket upwards while the yen crashes? Why does a single speech from a man in a suit cause the euro to lose 1% of its value in seconds? Most new traders rely entirely on technical analysis, lines on a chart. But lines on a chart do not move markets. Money moves markets. And money moves based on the economic health of a nation. We are about to enter the engine room of the global economy. We are going to discuss fundamental analysis. We are going to demystify the terrifying acronyms: GDP, CPI, NFP, FOMC. We are going to show you how interest rates act as gravity for currency, pulling capital across borders. If you think trading is just about drawing triangles, you are missing half the picture. The why is just as important as the where. Get ready to learn how to think like a central banker in Part 6. You are now entering the war room. Until this moment, we have discussed the mechanics of the car, the gears, the speedometer, the fuel. Now we are talking about the driver. And in the Forex market, the driver is not a person. It is a collective entity known as the central bank. To understand why a currency pair moves 500 pips in a month, you have to understand the single most powerful force in the financial universe: interest rates. Think of capital like water. Water always flows downhill, seeking the path of least resistance. Capital is similar, but it flows uphill seeking the highest yield. It flows to where it is treated best. If the United States offers a 5% interest rate on its government bonds, and Japan offers a 0% interest rate, where do you think the big money goes? It leaves Japan and floods into the United States. But here is the catch. To buy those US bonds, Japanese investors have to sell their yen and buy US dollars. This massive structural selling of yen and buying of dollars drives the US dollar to Japanese yen price up. It is a simple law of supply and demand, driven by the hunger for return. This is the foundation of fundamental analysis. It is the study of the economic health of a nation to determine the fair value of its currency. While technical analysis looks at the chart to see when to enter, fundamental analysis looks at the economy to determine which direction to trade. At the top of the food chain sits the Federal Reserve, the Fed, in the US, the European Central Bank, ECB, the Bank of England, BO, and the Bank of Japan, BOJ. These institutions have a dual mandate, or sometimes a single mandate, usually revolving around two things: controlling inflation and maintaining employment. When you watch the news and hear the Fed hiked rates by 25 basis points, you might tune out. Do not tune out. That announcement is a direct signal to the currency markets. A rate hike is generally bullish for a currency. It means the central bank is making that currency more expensive to borrow and more rewarding to hold. However, central banks do not just raise rates for fun. They do it to fight a monster called inflation. We measure inflation primarily through the CPI, Consumer Price Index. Imagine you are tracking the US dollar. The CPI report is released. It shows that inflation is rising hotter than expected. Prices for gas, milk, and housing are soaring. This is bad for consumers, so you might think it's bad for the currency. Incorrect. In the twisted logic of the Forex market, high inflation often leads to a stronger currency in the short term. Why? Because traders play a game of three-dimensional chess. They see high inflation and think, the Federal Reserve will panic. To stop this inflation, they must raise interest rates. Traders buy the dollar immediately, front-running the Federal Reserve's decision. They are buying the expectation of higher future interest rates. If the CPI comes in low, cooling inflation, traders think, the Fed can relax. They might cut rates. And they sell the dollar. This dynamic creates the most volatile moments you will ever experience on a chart. You need to know the big three data releases that shake the pillars of the market. First is the CPI, which we just discussed. Second is GDP, Gross Domestic Product. This is the report card of the economy. It measures the total value of all goods and services produced. If the US GDP is growing at 3% and the Eurozone GDP is contracting by -1%, the money will flow to the growth. It creates a long-term trend bias in favor of the dollar. Third, and arguably the most violent, is the NFP non-farm payrolls. On the first Friday of every month, at 8:30 a.m. Eastern Standard Time, the U.S. Bureau of Labor Statistics releases the NFP. It tells us how many jobs were added or lost in the U.S. economy, excluding farm workers. This is the Super Bowl of Forex. Scenario: you are sitting at your terminal at 8:29 a.m. on a Friday. The euro to US dollar is quiet. The spread is widening because the banks are pulling their orders. Everyone is holding their breath. The forecast is for 180,000 new jobs. 8:30 a.m. strikes. The number hits the wire. 300,000 jobs added. The US economy is on fire. It is stronger than anyone thought. Instantly, algorithms read the number and dump millions of euros to buy dollars. The euro to US dollar crashes 50, 60, 70 pips in a matter of seconds. If you were on the wrong side of this without a stop loss, your account is devastated. If you were on the right side, you made a month's worth of profit in a minute. But, and this is the deep dive nuance that separates professionals from amateurs, sometimes the market does the exact opposite of what the logic dictates. This brings us to the concept of priced in, and by the rumor, sell the news. Let's go back to that rate hike example. Everyone knows the Fed is going to raise rates. The CPI was high, the GDP is strong, and the Fed chairman basically promised it in a speech. For 3 weeks leading up to the announcement, the dollar has been climbing. Traders have been buying. The day of the announcement comes. The Fed raises rates exactly as expected, and the dollar crashes. The novice trader screams, "This is rigged." Good news means the price goes up, but the professional knows the truth. The price went up for 3 weeks because of the expectation. By the time the news actually happened, everyone who wanted to buy had already bought. There was no one left to buy. The only people left were profit takers. They sold the news. Fundamental analysis is not just about reading the numbers. It is about reading the market's expectation of the numbers. You have to ask yourself, is this data a surprise? If the NFP forecast is 180K and the actual is 185K, the market might not move at all. It's a nothing burger. But if the actual is 100K, a massive miss, the shock factor drives the volatility. Volatility is born from surprise. You must also understand the personalities of the central banks. They are not all created equal. The Federal Reserve (USD) is the elephant. When it moves, the whole world shakes. The European Central Bank (Euro) is often slower, more conservative, having to balance the needs of huge economies like Germany against smaller ones like Greece. The Bank of Japan (JPY) has historically been the outlier, keeping rates negative or near zero for decades to fight deflation. This divergence creates the carry trade. Imagine borrowing yen from a Japanese bank at 0% interest. Costs you almost nothing. You take those yen, convert them to US dollars, and buy a US bond paying 5%. You are pocketing the 5% difference just for holding the trade. When millions of investors do this, it creates a massive sustained trend. This is why US dollar to Japanese yen can trend upwards for months or years without stopping. It is supported by the fundamental flow of interest rate differentials. However, fundamentals are a long-term game. An economic shift takes months to play out. You, as a trader, are likely looking at a chart right now, trying to figure out where the price is going in the next hour. Fundamentals tell you the macro direction, but they don't tell you exactly when to enter. They don't tell you if you should buy at 1.0900 or wait for 1.0850. For that, we need a different toolkit. We need to analyze the psychology of the crowd. We need to look at the footprints left by the buyers and sellers on the screen. We need technical analysis, but not the messy, subjective lines you see on Instagram. We aren't going to teach you to draw random eagles or teacups on your chart. We are going to teach you the language of price action. We are going to look at structure, support, resistance, and the specific candlestick patterns that serve as the green light to execute the trade that your fundamental analysis suggested. You know the economy is the engine. Now let's look at the roadmap. How do you identify a trend before it's too late? How do you know when a trend is dead? Let's decode the chart in part 7. Remove the indicators. Delete the moving averages, the Bollinger Bands, and the RSI. Strip your chart naked. What you are left with is the raw truth of the market. Price action. Most new traders treat the chart like a video game. They think if they find the right combination of colorful lines, a buy signal will appear. This is a delusion. Indicators are just mathematical derivatives of price. They are lagging. They tell you what happened in the past. Price action tells you what is happening now. To understand price action, you must understand that the chart is a visual representation of human psychology. Every green candle represents greed, optimism, or panic buying. Every red candle represents fear, pessimism, or profit-taking. When you learn to read the candles, you are reading the minds of the millions of participants we discussed in the previous episodes. The first and most critical concept in price action is market structure. Markets do not move in straight lines. They move in waves. They inhale and exhale. We call these impulsive moves and corrective moves. Imagine a staircase. In an uptrend, the price pushes up to a new peak. This is a higher high. Then it pulls back down, but it stops higher than where it started the previous push. This is a higher low. This sequence, higher high, higher low, higher high, higher low, is the heartbeat of a bull market. As long as the price keeps making higher lows, the trend is healthy. Buyers are stepping in earlier and earlier to defend the price. They are aggressive. Conversely, a downtrend is a series of lower lows and lower highs. The sellers are in control, pushing the price deeper each time and preventing it from recovering to previous heights. The biggest mistake novices make is trying to catch a falling knife. They see the price crashing and think, it's too low, I have to buy. But if the market structure is showing lower lows and lower highs, you are standing in front of a freight train. You do not buy until the structure breaks. This brings us to the concept of the break of structure, BOS. Imagine you are watching an uptrend on pound sterling to US dollar. It has been making higher highs for days. Suddenly, the price fails to make a new high, stalls. Then it drops down and smashes through the previous higher low. The staircase has collapsed. The floor just gave way. This is the first technical signal that the trend might be dead. The dynamic has shifted from buyers being in control to sellers taking over. This is not a guarantee of a reversal, but it is a massive warning sign to stop buying. But where do these reversals happen? They don't happen in random space. They happen at support and resistance. You have likely heard these terms, but you probably use them wrong. Most beginners draw support and resistance as thin, precise lines. They see the price hit 1.2000 and draw a line exactly at that pixel. The market is not that precise. The market is messy. Support and resistance are not lines, they are zones. They are areas of interest. Think of support as a floor. It is a price area where buying pressure historically exceeds selling pressure. When the price drops into this zone, it bounces. Why? Because buyers perceive value there. Limit orders are sitting there waiting to be filled. Think of resistance as a ceiling. It is an area where selling pressure overwhelms buying pressure. The price hits it and falls. The most powerful phenomenon in technical analysis is the S/R flip. Imagine a ceiling in a multi-story building. If you smash through the ceiling and climb to the next floor, that old ceiling becomes your new floor. In trading, when a resistance level is broken, it often becomes support. Why? Psychology. Imagine traders sold at a resistance level of 1.0500. The price breaks up to 1.0600. Those traders are now losing money. They are praying for the price to come back down to 1.0500 so they can exit their losing trades at break-even. Simultaneously, traders who missed the breakout are waiting for the price to come back to 1.0500 to get in. When the price returns to 1.0500, both groups buy. The shorters buy to cover, and the new bulls buy to enter. This combined buying pressure launches the price upward. This is the break and retest strategy, and it is the bread and butter of professional price action traders. So you have the structure, the trend, and the location, the zone. Now you need the trigger. You don't just blindly place a limit order at the zone. You wait for confirmation. You wait for the market to tell you, yes, we are rejecting this area. This is where candlestick patterns come in. We are not talking about complex patterns like 3 black crows. We are focusing on the single most effective signal in Forex, the pin bar or hammer/shooting star. Look at the anatomy of a pin bar. It has a small body and a very long wick or tail. Let's analyze the story this candle tells. Imagine a shooting star pin bar at a resistance level. The candle opened. Buyers pushed the price up aggressively, trying to break the resistance. They failed. Sellers stepped in with overwhelming force and smashed the price back down, closing the candle near the bottom. That long wick represents a battlefield where the buyers were slaughtered. It is a visual representation of rejection. It screams, the market does not want to be here. If you see a shooting star pin bar forming exactly at a resistance zone, while the market structure is starting to shift down, that is a high probability trade. You have 3 layers of evidence: location, structure, and signal. Let's construct a high probability case study. The setup. You are looking at US dollar to Canadian dollar. Fundamental bias. Oil prices are dropping, weakening the Canadian dollar, and the Fed is hawkish, strengthening the US dollar. You want to buy. Structure. The daily chart is in a clear uptrend. Higher highs and higher lows. Location. The price pulls back to 1.3500, a previous resistance level that should now act as support. Signal. On the 4-hour chart, the price touches 1.3500 and forms a massive bullish pin bar with a long wick sticking down. This is the A+ setup. You buy at the close of the pin bar. You place your stop loss below the wick, because if the price goes below the wick, your thesis is wrong. You target the next higher high. This sounds perfect, but there is a problem. The market knows you are looking for this. The institutions know exactly where retail traders put their stop losses. They know you put your stop just below that support level. Often, you will see the price dip just below the support, triggering all the stop losses and then fly upwards. This is called a liquidity grab, or a fake out. Feels like a personal attack, but it isn't. The big banks need liquidity to fill their massive orders. Your stop losses are that liquidity. To survive this, you need more than just naked eyes. Sometimes you need tools to filter out the noise. You need objective data to confirm what your eyes are seeing. Are there tools that can help us spot the strength of a trend? Are there mathematical formulas that can warn us when a reversal is actually a trap? Yes, they are called indicators, but 99% of traders use them incorrectly. They use them as crystal balls instead of flashlights. In the next part, we are going to open the toolbox. We are going to discuss the moving average, the RSI, and the Fibonacci retracement. We will show you how to use them to confirm your price action thesis without becoming a slave to them. We are going to teach you how to distinguish between a leading and a lagging signal, and why relying on the golden cross might be the reason you are still losing money. Let's add the filters in part 8. Let's address the golden cross fallacy immediately. If you go to any basic trading website, they will tell you that when the 50-day moving average crosses above the 200-day moving average, it is a buy signal. They call it the golden cross. It sounds majestic, sounds profitable, but if you backtest this blindly on a lower time frame like the 1 hour or 15-minute chart, you will likely find that it burns money. Why? Because moving averages are lagging indicators. They are calculated based on past data. By the time the 50 crosses the 200, the massive move that caused the average to rise has often already finished. You are buying the top. You are entering the party right as the police are showing up to shut it down. Indicators are not triggers. They are filters. Think of your trading strategy like a water filtration system. The raw market data is dirty water, full of noise, fakeouts, and erratic movements. Your job is not to drink the water. Your job is to filter it until only the crystal clear, high probability setups remain. Let's start with the most popular filter in existence, the moving average. We are going to ignore the simple moving average, SMA, for now and focus on the exponential moving average, EMA. The EMA places more weight on recent price data, making it react faster to current market conditions than the sluggish SMA. The single most important line you can put on your chart is the 200 EMA. This is your line in the sand. It is your directional compass. Institutional traders look at the 200 EMA to determine the long-term trend. Here is the rule. If the price is trading above the 200 EMA, you do not sell. You only look for buy opportunities. If the price is trading below the 200 EMA, you do not buy. You only look for sell opportunities. By strictly following this one rule, you instantly eliminate 50% of the bad trades you would have taken. You stop trying to pick bottoms in a crash. You stop trying to short a rocket ship. You are forcing yourself to trade with the current. But the 200 EMA is a slow-moving beast. For entry timing, we need something faster. Enter the 20 EMA. In a strong, healthy trend, the price will rarely touch the 200 EMA. It will surf along the 20 EMA like a magnet. This creates a strategy known as dynamic support. Imagine the euro to US dollar is trending up strongly. It pushes away from the 20 EMA, then pulls back to touch it. It kisses the line and bounces. That kiss is a potential entry point. The 20 EMA acts as a dynamic trend line that moves with the price. If you combine a pullback to the 20 EMA with a horizontal support zone from part 7 and a pin bar from part 7, you have a high confluence setup. You have 3 independent witnesses telling you the same story. Now, let's look at the RSI, Relative Strength Index. This is the most misunderstood tool in the box. Novice traders are taught a binary rule. If RSI is above 70, the market is overbought, so you should sell. If RSI is below 30, the market is oversold, so you should buy. This advice is financially dangerous. In a runaway trend, the RSI can stay above 70 for weeks. If the momentum is incredibly strong, the market can remain overbought, while the price doubles. If you sold every time the RSI hit 70 in a strong uptrend, you would be wiped out. The real power of the RSI is not in its absolute number, but in divergence. Divergence is a crack in the foundation. Imagine a car driving up a hill. The car is still moving forward, price is making higher highs, but the driver is taking his foot off the gas pedal, momentum is making lower highs. The car is decelerating. It hasn't stopped yet, but a reversal is imminent. If you see the price of pound sterling to US dollar making a new higher high, crashing through resistance, but your RSI indicator makes a lower high compared to the previous peak, this is bearish divergence. It tells you that the buyers are exhausted. The volume backing the move is drying up. If you see this divergence occurring exactly at a major resistance level, it is a massive red flag to exit your long positions or look for a reversal entry. Finally, we have the magic ruler, the Fibonacci retracement. Is there a mathematical code embedded in the universe? Maybe, but in Forex, Fibonacci works because of the self-fulfilling prophecy. Algorithms, hedge funds, and banks all watch specific Fibonacci levels. Because they all watch them, they all place orders there. Because they all place orders there, the price reacts there. To use this, you identify a major swing, a clear move from a low point to a high point. You draw the Fibonacci tool from the absolute low to the absolute high. The tool will project horizontal lines across your chart. The most critical level is the 61.8% level. This is known as the golden ratio. Case studies of market movements show a frighteningly high frequency of price retracing, exactly 61.8% of a move, before continuing in the original direction. Why? Because it represents a deep discount. If you are a bank and you missed the initial move up, you don't want to chase the price. You want to buy it on sale. A 61.8% pullback is that sale. There is also the 50% level. While not technically a Fibonacci number, it is a major psychological level. Dow theory suggests that markets tend to retrace 50% of their primary moves. So, how do we synthesize all of this into a coherent strategy? We look for confluence. A confluence setup is when multiple unrelated tools line up at the exact same price point. Imagine this scenario. Trend. The daily chart is in an uptrend. Price is above the 200 EMA. Price action. The price has pulled back from a recent high. Structure. The price drops into a previous resistance zone that should now act as support, the S/R flip. Fibonacci, you draw your fibs, and you see that the 61.8% golden ratio lines up perfectly with that support zone. Indicator. You look at the RSI and see hidden bullish divergence. Price made a higher low, but RSI made a lower low, indicating hidden strength. Trigger, you wait. You do not buy yet. Suddenly, a 1-hour pin bar forms rejecting that exact zone. This is the holy grail of trading setups. It is not a guarantee, nothing is, but the probabilities are heavily stacked in your favor. You have the trend, the structure, the math, the momentum, and the signal all pointing north. If you take trades like this, you are trading like a sniper. You are waiting for the perfect shot. But here is the harsh reality that no indicator can save you from. You can have the perfect confluence setup. The stars can align. The RSI, the fibs, and the structure can all scream buy. And you can still lose. The market can simply decide to ignore you. A sudden news event can invalidate the technicals in a millisecond. A massive order from a central bank can smash through your support level like it's tissue paper. If you bet 50% of your account on this perfect trade, because you were so sure it would win, you are now bankrupt. This brings us to the single most important topic in this entire masterclass. The topic that is more important than pairs, pips, sessions, and strategies combined. It is the only thing you have 100% control over. You cannot control the price. You cannot control the news. You cannot control the market. You can only control risk. If you do not understand R multiples, position sizing, and the 1% rule, you are mathematically guaranteed to fail. Even with a 90% win rate, poor risk management will eventually destroy you. We are about to discuss the mathematics of survival. We are going to show you how to lose 10 trades in a row and still make money. This is the part that separates the gamblers from the professionals. Let's talk about money management in part 9. Welcome to the most boring and most important part of your career. I can teach you how to read the liquidity graphs in the London session. I can teach you how to spot a divergence on the RSI with your eyes closed. But if you do not master the mathematics of risk management, you will eventually hit zero. It is a statistical certainty. There is a famous saying on Wall Street. There are old traders and there are bold traders, but there are very few old, bold traders. Most new traders treat the market like a slot machine. They put money in, pull the lever, place a trade, and hope for a jackpot. If they lose, they put more money in. This is gambling. Professional trading is not gambling. It is actuarial science. It is the business of probability management. Let's start with the concept that destroys 90% of accounts. The drawdown math. Imagine you have a $10,000 account. You take a trade and risk 10% of your account because you are confident. You lose. You now have $9,000. To get back to your original $10,000, you need to make $1,000. That is an 11.1% gain on your new balance. Not too bad. But let's say you go on a losing streak, which happens to everyone, even the best hedge funds in the world. You lose 50% of your account. You are down to $5,000. Here is the trap. To get back to $10,000, you do not need a 50% gain. You need a 100% gain. You have to double your money just to break even. If you lose 90% of your account, dropping to $1,000, you need a 900% gain to recover. This is the death spiral. As your capital shrinks, The percentage return required to recover grows exponentially. This is why the number one rule of trading is not make money. It is protect capital. To avoid the death spiral, you must adopt the 1% rule. This rule is non-negotiable for beginners. You never, under any circumstances, risk more than 1% of your account balance on a single trade idea. Let's run the simulation. You have that same $10,000 account. You risk 1%, $100. You lose 10 trades in a row. A disastrous streak. After 10 losses, you are down roughly $1,000. Ignoring compounding for simplicity, your balance is $9,000. You are still in the game. You still have 90% of your ammo. You can sleep at night. You can think clearly. The bull trader who risked 10% per trade? After 10 losses, he is mathematically eliminated. He is blown out. But wait, if you only risk 1%, how do you get rich? If you only make $100 or $200 profit, it will take forever to buy that Lamborghini, right? This brings us to the R multiple risk to reward ratio. This is the secret sauce. Professional traders do not care about win rate. They care about expectancy. Novice traders want to be right 90% of the time. To achieve this, they use huge stop losses to avoid getting hit and take tiny profits to bank the win quickly. They might risk $500 to make $50. This works for a while. They feel like a genius. They win 9 trades in a row, plus $450 profit. Then the market moves against them. They lose that one trade with a huge stop loss, minus $500. 10 trades, 90% win rate, net loss of $50. The professional trader flips this equation. They target a risk to reward ratio of at least 1 to 2 or 1 to 3. This means for every $1 they risk, they expect to make $3. Let's look at the math of a 1:3 risk-reward strategy with a terrible win rate. Imagine you take 10 trades. You lose 7 of them. You are wrong 70% of the time. You win only 3 of them. You are right 30% of the time. This sounds like a disaster, right? Let's do the math. 7 losses x 1% risk equals minus 7%. 3 wins x 3% reward equals plus 9%. Net profit, plus 2%. You lost more than twice as often as you won, and you still made a profit. You can be wrong the majority of the time and still make a living. This removes the pressure to be perfect. You don't need to predict the future. You just need to manage the payout. Now we have to execute this. How do you actually ensure you are risking exactly 1%? Most beginners guess. They think, I want to trade euro to US dollar, so I'll just buy 0.10 lots. This is reckless. Your lot size cannot be arbitrary. It must be calculated based on the distance of your stop loss. This is called position sizing. Here is the step-by-step formula you must perform before every single trade. Step 1. Determine your dollar risk. Account balance, $5,000. Risk percent, 1%. Dollar risk equals $50. Step 2. Determine your stop-loss distance. You analyze the chart. The support level is at 1.0900. You want to buy at 1.0920. You place your stop loss at 1.0895, 5 pips below support. Distance equals 25 pips. Step 3. Calculate pip value. You have $50 to spend on 25 pips. $50/25 equals $2 per pip. Step 4. Convert to lots. In standard lots, $10 per pip equals 1.0 lot. Therefore, $2 per pip equals 0.20 lots. If you enter this trade with 0.20 lots, and the price hits your stop loss, you lose exactly $50. Now imagine a different scenario. Same account, $5,000. Same risk, $50. But this time, you are trading a volatile pair like pound sterling to Japanese yen, and your stop loss needs to be 50 pips wide to be safe. $50/50 pips equals $1 per pip. Your lot size is now 0.10 lots. See the difference? Same risk, different position size. If you had used the 0.20 lots from the first trade on the second trade, you would have lost $100, 2%, violating your rule. Consistency in risk amount creates a consistent equity curve. If you risk 1% on trade A and 5% on trade B, and trade A wins but trade B loses, you are losing money despite a 50% win rate. You are letting luck dictate your P&L. This leads to the psychology of the casino edge. Casinos do not panic when a gambler wins a hand of blackjack. They do not get angry. They do not try to win it back on the next hand. They know that over a series of 1,000 hands, the statistical probability, the house edge, guarantees they will win. You must become the house. Your trading strategy, your confluence from Part 8, provides the statistical edge. Your risk management ensures you stay at the table long enough for that edge to play out. If you treat losses as being wrong or being stupid, you will trigger an emotional response. You will revenge trade. You will try to make the money back immediately by doubling your lot size. This is called martingale, and it is the fastest way to bankruptcy. Instead, treat losses as the cost of goods sold. If you run a coffee shop, you have to buy coffee beans, an expense, to sell coffee, a profit. In trading, losing trades are just the coffee beans. You pay them willingly to get to the winners. However, there is one variable we haven't accounted for yet. We have built the car, the pair, tuned the engine fundamentals, mapped the road technicals, and put on the seatbelt, risk management. But who is driving the car? You are. And you are a human being. You have emotions. You have fear. You have greed. You have an ego that hates to be wrong. You can have the perfect strategy and the perfect risk plan, but if you freeze when it's time to pull the trigger, or if you move your stop loss because you hope the price will turn around, the math doesn't matter. The final boss in this game is not the market. It is not the banks. It is the person staring back at you in the mirror. Why do 90% of traders fail even when they know the rules? Because they cannot conquer their own biology. In the final part of this masterclass, we are going to dissect trading psychology. We are going to talk about tilt, FOMO, and the discipline required to do nothing when the market offers you nothing. This is the mental framework of the top 1%. Let's finish this journey in part 10. You are now face to face with the final boss. It is not the algorithm. It is not the Federal Reserve. It is your own amygdala. The primitive part of your brain designed to keep you alive in the jungle, but designed to bankrupt you in the financial markets. Trading psychology is the filter through which all your knowledge must pass. You can have a PhD in economics, you can know every candlestick pattern in the Japanese archives, and you can have a risk model that would impress a NASA engineer. But if you cannot control your thumb when your heart rate hits 120 beats per minute, you are finished. Let's analyze the first psychological killer, FOMO, fear of missing out. Imagine this scenario. It is 8:30 a.m. The CPI data drops. You plan to buy euro to US dollar if it hit a specific support level of 1.0500. But the news is so good that the price doesn't pull back. It just shoots up. 1.0520, 1.0540, 1.0560. You are watching the green candle grow taller and taller. Your brain starts screaming at you. Everyone is getting rich but me. If I don't buy now, I will miss the entire move. The dopamine in your system spikes. You abandon your plan. You abandon your entry criteria. You click buy at 1.0565, right at the top of the candle. The moment your order fills, the momentum dies. The early buyers, the professionals who bought at 1.0500, begin to take profit. They sell their positions to you. You provided their exit liquidity. The price immediately reverses. It drops to 1.0540. You are instantly underwater. This is the FOMO trap. You chase the price. The market is designed to elicit this exact reaction. It lures you in with volatility and traps you with reversion. Case studies of successful traders show a trait known as JOMO, joy of missing out. When a trade takes off without them, they do not feel pain. They feel relief. They think, I preserved my capital. I did not chase. There will be another bus in 10 minutes. The second killer is the dark twin of FOMO, revenge trading. This usually happens after a bad beat. A bad beat is when you did everything right, you followed your plan, you managed your risk, and you lost anyway because of a random market spike or a spread widening. You feel a physiological response. Your face gets hot. Your stomach tightens. This is the fight or flight response. In poker, this is called going on tilt. Your ego takes over. You think, the market stole my money. I need to get it back. Now, you look at the chart. There is no setup. There is no confluence. But you don't care. You see a red candle and you short. You double your lot size because you want to recover the loss plus a profit in one trade. This is where the account dies. The market detects your aggression and punishes it. You lose the second trade. Now you are down 4% or 5%. The rage turns into desperation. You open a third trade, max leverage. You are gambling now. You are not analyzing, you are praying. When the margin call hits, you stare at the screen in silence, wondering how you lost a month's worth of discipline in 45 minutes. To combat this, you must implement a circuit breaker rule. Just like the New York Stock Exchange halts trading if the market drops 7%, you must halt yourself. If you lose 2 trades in a row, you are legally forbidden by your own trading constitution from trading for the rest of the day. You must walk away. Turn off the PC. Go outside. The chemical cocktail of cortisol and adrenaline in your blood takes about 60 to 90 minutes to dissipate. You are physically incapable of making a rational decision during that window. Now let's talk about the state of mind you should be aiming for: boredom. If you are having fun while you trade, you are probably losing money. If your heart is racing, you are risking too much. Real professional trading is incredibly boring. It is repetitive. It is like working on an assembly line. You sit. You wait some more. A setup appears. You check your checklist. Does it meet the criteria? No. You wait. Yes. You execute. You set your risk. You walk away. George Soros, one of the greatest traders in history, famously said, "If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. You are a sniper lying in the grass for 3 days, waiting for one single perfect shot. You are not Rambo running into the jungle with a machine gun firing at everything that moves. Rambo runs out of ammo money. The sniper survives." So, how do you master this psychology? How do you train your brain to embrace boredom and reject FOMO? You need a trading journal. I do not mean a list of numbers. Bought at 1.05, sold at 1.06. That is an accounting ledger, not a journal. A psychology journal tracks your emotional state. Before you take a trade, you must write down, "How do I feel right now?" If you write, "I feel anxious, I feel excited," or "I feel like I need to win," you do not take the trade. If you write, "I feel calm, I don't care if this wins or loses, and this matches my plan perfectly," then you execute. Over time, this journal will reveal your edge. You might discover that you lose 80% of the trades you take before 9 a.m. because you are not fully awake yet. You might discover you lose every time you trade the pound sterling to Japanese yen pair because the volatility scares you into closing early. Data removes the mystery. It turns your failures into statistics that can be fixed. The conclusion: we have come a long way in this deep dive masterclass. We started by tearing down the misconception that Forex is a get-rich-quick scheme. We built up your knowledge layer by layer. The pair: you learned that you are trading a relationship between 2 economies, not a stock. The mechanics: you learned about pips, lots, and the double-edged sword of leverage. The arena: you learned about the sessions Tokyo, London, New York, and when the money actually flows. The fundamentals: you learned that interest rates and inflation are the gravity that pulls price. The technicals: you learned to read market structure, ignore the lagging indicators, and spot the footprints of institutional money. The mathematics: you learned that risk management is the only thing that keeps you alive during a losing streak. The psychology: and finally, you learned that you are your own greatest enemy. Forex trading is the hardest way to make easy money. It requires you to master economics, mathematics, and psychology simultaneously. It demands that you accept failure as part of the process. You will lose trades. You will make mistakes. You will have days where you want to quit. This is the price of admission to a profession that offers unlimited scalability and total freedom of time and location. Do not rush. The market will be there tomorrow. It will be there in 10 years. The euro to US dollar is not going anywhere. Your goal for the next 90 days is not to make $1 million. Your goal is to not lose your account. If you can survive for 90 days without blowing up, you are already ahead of 90% of the people who try this. Focus on the process, not the profit. Master the setup. Master the risk. Master the mind. This concludes the Understanding Forex Pairs Masterclass. But this is just the theory. Theory is useless without application. You need to see this in action. You need to see how a professional analyzes a live chart, in real time with real money on the line, navigating the news and the noise. That is exactly what we are going to do next. We are going to take everything we just learned and apply it to the live markets. I am going to show you my screen, my entries, and my exits. Click the video on your screen right now to enter the live trading lab. I'll see you in there. Let's get to work.